The United States is a popular destination for Chinese companies seeking to go public to raise capital. But increasingly, Chinese markets are becoming another alternative destination for these fundraising activities.
Out of the top 25 global IPOs year to date, 8 were by Chinese domiciled companies, and just under half chose to list in the US, with the majority listing in home markets in China. And IPOs taking place on Chinese exchanges make up about a third of global volumes this year at just over $30 billion.
Refinitiv data showed there were 249 IPOs in mainland China so far this year, raising $33.7 billion, a jump of more than twofold from the same period last year. The Nasdaq-style tech board, which China launched in Shanghai last year, has catalyzed listing activities on the mainland. Called the Science and Technology Innovation Board, or STAR Market, it's attracting startups and up-and-coming businesses to raise money.
The STAR Market will give Nasdaq a good run for its money. If we look at the main index, the STAR 50, it has outperformed Nasdaq by about double this year. STAR has streamlined its listing process to facilitate the process for tech startups, and it's quickly become one of the largest markets for IPOs in the world, overtaking other Chinese trading venues by quite some margin.
Chinese companies going IPO on the mainland tend to list simultaneously in Hong Kong. Alibaba's Ant Group, China's largest online payments platform, is set to be the latest to do a dual offering that could raise a record $30 billion.
Many of these companies want to make sure they list outside of China, so they actually have a lot of free cash to operate globally. You know, this is still the benefit of Hong Kong, that it's outside the great currency wall of China. You can raise a lot of money in China, but if you're looking to acquire things overseas, whether that be technology, whether that be companies or invest overseas, having money in China only helps you so much. You still need approval to get your money out.
But market watchers have a word of caution for investors on these dual listings.
Some of the companies with a dual listing, they have actually different prices on different exchanges, and in some cases these prices are massively different. Some companies have a dual listing in Hong Kong, they're called A shares, and in the mainland they're called A shares. And on average, the A shares are 42% higher, or traded 42% higher prices right now. And these are identical companies. In fact, some companies even traded over 6 times the price in the mainland compared with Hong Kong. So it's very important to look across all the exchanges to make sure one does not overpay for the same kind of, company, essentially.
As more and more Chinese companies turn to the domestic market to raise funds, it will reach critical mass and mature as a listing destination.
You have the Shenzhen market trying to rival Nasdaq. Now you have Shanghai also coming up. It doesn't necessarily mean the geopolitics will have to escalate. I think it's a trend that sooner or later was going to be inevitable anyway.
The US capital markets also continue to remain attractive to Chinese companies. Year to date, there have been 33 listings by Hong Kong and mainland China companies in the United States. These have raised a combined $12.2 billion on Nasdaq and the New York Stock Exchange. That's a jump of 46% from the same period last year.
US markets are the deepest in the world, and they generally offer solid growth opportunities and access to more global capital. And this is important for particularly regional businesses that are looking to grow globally. We do see that the NYSE and Nasdaq continue to dominate for IPOs, and it is by many companies, particularly the larger private companies, seen as the preferred listing venue of choice.
Just last month, electric vehicle maker XPeng debuted on the NYSE, raising $1.5 billion from its IPO. There are some risks, though. US regulators are stepping up scrutiny of US-listed Chinese companies. These companies will need to comply with US auditing standards or face delisting. The threat of forced delistings has prompted some US-listed Chinese companies to seek secondary listings in Hong Kong.
This is a really interesting trend, and I think this is probably one of the most interesting things that's happening in the markets at the moment. So Chinese venues dominate the global markets for secondary listings. Recently, we have seen several major Chinese tech companies listed in the US already filing for new listings in China. We've seen it for a little while, but it's really picked up speed this year.
So far, $11.9 billion has been raised in the city via secondary listings. Yum China, which runs the country's Pizza Hut and KFC restaurants, is the latest to do a secondary listing. Other companies that have done so include Alibaba, online retailer JD.com, and game developer NetEase.
One question that we get quite a lot from our clients is, given the situation between US and China and the increased regulatory scrutiny of the Chinese listings in the US, what should they do? Based on the current situation, we do not really anticipate an disorderly delisting of these Chinese ADRs in the US. So it is not necessary for investors who's actually holding on to some of these Chinese ADRs to panic sell out of them, unless there is a significant deterioration of the corporate fundamentals of those specific companies. For those companies that are already dual listed, investors may consider switching their existing ADR holdings to the non-US listing, for example, in Hong Kong, as long as the switching cost is not exorbitant. The ease of switching from the US to Hong Kong listing has also helped to facilitate some of these moves.